What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode, I'm doing another stock market technical analysis update. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along with all of my updates. First up, we have the ticker symbol SPY, which is the SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. Alright, so if you're new to the channel or you just forgot, remember we're fully expecting the stock market to still go into this ABC correction. And right now we're trying to figure out where the end of this correction is going to be in this wave C of the correction. So today we did see a bounce on the SPY ETF closing up over 1%, but we still do see bearish price action closing below the 5 EMA as well as below the 50 EMA. And we still have that 5 EMA crossing down below the 50 EMA as well as the 13. So we still have a bearish trend and we still have bearish price action, even though we did have a technical bounce on today's close. So another thing to note is we did go ahead and close this gap that we've had open. And remember, I said there was a good chance when we got down and closed that gap and got into this Fibonacci retracement level of $325, there was a good chance we were going to see a bounce. So technically speaking, this bounce is not that surprising, but that doesn't mean we're out of the water yet. And that doesn't mean this bearish trend is over, because we still have bearish price action and bearish trending going on. So we could still easily come back up to the 50 EMA and get rejected and come back down to these lower Fibonacci retracement levels of $315 as well as $305. So one thing I want to make it known is when we're in these corrections, you never want to try to call the bottom, or you never want to try to catch a falling knife. So if we go back over to the correction back in the crash of March and we sort of step through this bounce, after the A wave we had the B bounce and then we started down on the C wave. So we started down, and on the way down, we did see bounces every now and then, as you can see here, and we still see that the price action's below the 5 EMA and we still have that bearish trend. If we continue to step through this C wave, we see that we continue down after that bounce, and then ultimately we saw another bounce with the price action still below the 5 EMA and we still have that bearish trend. So if we continue to step through this, we see that we continue down yet again, and then we saw another bounce, but we're still below that 5 EMA. So as we continue to step through, we see that the correction was still heading lower, and we still saw lower price action following that bearish trend and those bearish price action closes. So as we continue to step through, we do finally see that the stock market finds a bounce off of a lower low, and we do start to see that that bounce now closes above the 5 EMA, and that's our first sign that there's going to be a trend reversal from that bearish trend. As we begin to step forward in time, we see that that trend continues, and ultimately, we eventually do see that 5 EMA cross back above the 13 EMA, and we see that price action eventually close back above the 20 simple moving average. So remember right now, the trend is our friend, and we have to acknowledge the fact that anywhere in this trend, we did see technical bounces, but the trend was still bearish the entire time, because we saw the 5 EMA below the 13 as well as the price action closing below the 5 EMA. Now, not every correction is going to be as bad as the correction we had in March, and we're not trying to say that this correction is going to be an equivalent crash like we saw in March. However, the point I'm trying to make is that when we're in a downtrend and we have bearish price action and bearish trending going on, we don't want to try to call the bottom and say that it's over and that we're going back into a bull market until we see that confirmation in the technicals. So right now on the SPY ETF, we're fully trading in a bearish pattern with the price action still below the 5 EMA, as well as we're now trading below the 50 EMA, and we still have that bearish trend of that 5 EMA below the 13 EMA. But we can't ignore the fact that we did come into this Fibonacci retracement level of a 0.618 of the one move down for A wave, as well as a 0.236 of the larger bull run. So we are starting to see a bounce off those levels, and we need to acknowledge that if that bounce continues and we can get a close on the SP 500 above the 5 EMA and start to see that trend reversal, we very well could have seen the end of this correction. So remember, there's no reason to believe that this isn't just a small correction in the grand scheme of a large bull market, and we're just in that ABC correction before potentially resuming that bull market. But right now, we have to acknowledge that we're in that bearish trend and we have that bearish price action, and we don't know for sure that this is just going to be a temporary correction until we see confirmation in the technicals and the price action that the short-term bearish trend's reversed. And then we could say that the correction is over and the bull market can continue. So right now we're going to remain cautious and we're going to trade with what's in front of us. And we still have to acknowledge that what's in front of us is still a bearish trend. So if we do come up into these moving averages and find resistance, I would expect to see the price action come back down to the next Fibonacci extension level of $315. If we start breaking down below 315, of course we have our next Fibonacci retracement level of $305. But I would expect to see significant support at this Fibonacci retracement level of 1, but we still need to see if we get a bounce off of that, if we're going to form a higher high or a lower high because if we continue to head down with a lower high and lower low situation, that means we're going to remain in this bear market. Now, this is a great opportunity if you're a trader and you know how to find these support levels. You can make short-term trades and make profitable trades very quickly. But we're talking about looking for an opportunity to go long on this market and become a long-term holder of stocks again. So in order to become a long-term holder and we want to go long on the market, we really want to see a trend reversal where we see a higher high and a higher low before ultimately resuming higher and forming new higher highs. So right now we're going to watch the trend and we're going to watch the price action, and we have to acknowledge this bounce right now, but we also have to acknowledge that there's still significant resistance above, and we also have that 20 simple moving average that's rolled over and is now heading down in a negative direction. Anytime the 20 simple moving average heads negative, that means we're in a bearish trend. And if you're not sure exactly what that means, just go look at a chart, put up the 20 simple moving average on the SP 500 and watch every time the 20 simple moving average goes negative, how long the price action takes to go back to a bull market. So if we go over to a 1 hour chart, we can still see that we're forming these lower highs after we've double topped at this $342 level. Now, we did have this support level broken down from the double top, which is a break of the neckline. And that means we do have an official double top and we can expect to see lower price action. We also see that neckline that used to be support is now holding up as resistance, and we see that that support level was resistance here, and we see that we're coming back into that level very soon to test it yet again. If we get back up into this old support level and we see it act as resistance and we head lower, that will be another very bearish sign that the S&P 500 is going to new lower prices. So right now it's hard to become bullish on the S&P 500 just because we had one good day of going up 1%, and ultimately the price action and the trend are still looking more bearish than bullish, so we need to respect the trend, and right now that's still bearish. So going back to a daily chart, we're still looking to see if we come back into this $325 level, if it's going to remain as support. And we're also still waiting to see if we can get a close above some of these moving averages to see if the bulls can gain some momentum and try to reverse this trend and take back control from the bears. But right now it still looks like the bears are fully in control. And after going out through the bottom of the Bollinger Band, it's not surprising to see a technical bounce like today for the bears to reset and wait for the price action to go back into these resistance levels before they try to short the market down to lower prices. You can also see evidence that today's bounce was not a follow through by the big money, because we do see a reduction in volume. And remember, big money has a lot of volume. They have all that money. If they're trying to get back in, we're going to see a spike in volume on an up day. And we didn't see that today. We saw an up day on lower volume. And we still see that these down days, the last 4 days that the market was going lower, we saw higher volume. So that's still evidence that we're seeing higher volume on selling days and lower volume on bounce days like today, which tells us that the big money is still not trying to get back in the stock market, and more than likely they're just letting the market bounce a little bit so that they can continue selling into strength. So right now we're still in full defense mode and we're protecting our capital, and we're not going into a very big position on a long position on the stock market just yet, because we still have this bearish trend that we have to get through. Next up, let's take a look at the Nasdaq 100, and we're looking at the QQQ ETF, or the triple Qs, and we see that the Nasdaq 100 had quite a good day today, closing up 1.86%. Now on the Nasdaq 100, we're still fully expecting that ABC correction as well, and we do see today's price action bouncing and closing above the 50 EMA as well as the 5 EMA. However, our resistance that we've been respecting on the Nasdaq 100 has been this 13 EMA, and we've seen it act as resistance here and as well as these 2 days here. So it wouldn't be surprising to see the Nasdaq 100 triple Qs come back up into the 13 EMA and test it as resistance yet again. And if we do get rejected at the 13 EMA and head lower, it would be a lower low on the stock market, which is a bearish trend. Now, if we do break down below this 0.618 Fibonacci retracement, which was at the $259 level, we are looking for the next support level to be at $250. So we still do have a bearish trend on the Nasdaq 100, and we are getting very close to coming back into one of the most critical resistance moving averages, which is that 13 EMA. We also see on the Nasdaq 100, the 20 simple moving average has gone negative, and that's always going to be a sign that the bearish momentum is picking up, and that a short-term bear market is now turning into a medium-term bear market. The longer that 20 simple moving averages stays negative, the more momentum the bears have to pull this into lower price targets. So we did also get a bounce off the 0.618 Fibonacci on the Nasdaq 100, and we have to respect the fact that if we can come off this level, close up above this important resistance level and form a new higher high, and then form a higher low, we have to acknowledge that this ABC correction could be over and we're ready for the bull market to resume. but it's still too early to say that, and we still have bearish price action on bearish trends, and we have to respect the fact that the trend is still bearish, and we don't want to prematurely say that the bottom is in, because the market could continue to sell off as soon as tomorrow, and we could see significant lower prices before we see the end of this correction. So next up, let's take a look at the Dow Jones Industrial, and we're looking at the DIA ETF, and we see the Dow Jones did not have a very good day today, closing up only 0.5% higher on much lower volume and well below the 50 EMA. We see that we're closing well below the 5 EMA, and that 5 EMA is starting to become very negative, sloping to the downside and getting ready to cross back below the 50 EMA. Now on the DIA ETF, we still have this gap down here at $264, and I'm still fully expecting to see that gap close, because we have now officially seen the gaps close on the Nasdaq 100 as well as the SP 500. So I wouldn't be surprised to see that the Dow Jones is also going to come down and close this gap, because the bears are in full control and the bears know that gap is there. They're going to come down and attack that gap, and I would not be a buyer of the Dow Jones until this gap closes and we see a confirmation bounce to the upside. And then if we can start seeing a trend reversal, the Dow Jones could be a great opportunity to start a position for the long term. Remember, the Dow Jones never did form a new higher high after the crash, and we still formed that lower high. So overall, the Dow Jones is still in somewhat an overall bear market, because we have that lower high on a grand scheme of things. However, the Dow Jones also has more potential gains, and maybe we can see the Dow Jones come back up off of these critical support levels and come back up here and form new higher highs to finish out the year. Now that's going to take a lot of good news and a lot of things to happen in the right way. So right now, let's just trade with what's in front of us, and we see the Dow Jones is still in a full correction, in a bearish pattern with bearish price action, with a gap below us at $264. We also have this strong Fibonacci retracement level at 266. So anywhere around that level, I would expect to see the Dow Jones find considerable support and should see a potential bounce. Next up is the VIX, which is our fear indicator, and we see the VIX coming in right at support. So we have the indices coming in at resistance levels, and we have the VIX landing right on a support level, which tells me I'm expecting the VIX to bounce off support, which would be the opposite of our ABC. On the VIX, we see ABC going to the upside, while we see the stock market going to an ABC correction to the downside. So right now we have the VIX closing right around that 20 simple moving average, and we still have a confluence area where all these moving averages are bunching up, and the VIX is really just building up support and building up energy for its next move, which I would predict to be to the upside. So I would have no surprise to see the VIX explode up to the upside any day now, which would be followed through with a huge sell-off in the stock market. And that's why I'm saying remain cautious. I'm not saying that a huge sell-off is definitely coming, but it's looking like a proper setup is happening in the stock market right now, where we do have that sort of cool-off technical bounce, and it's now giving bears more energy and getting ready for that next leg down in any event that the bears want to bring this market down further, or that the big money wants to continue to sell some of their position. We know that they have a lot of volume that they have to sell off, and they're going to cause panic, and they're going to cause fear, and they're going to cause the retail investors to dump out of their positions in any event that the market starts suddenly dropping. So we'll see that in the VIX, and right now we're seeing the VIX setting up, getting ready for a bounce, which is telling us that fear could be coming right back into this market. So next up, let's take a look at the sectors driving this market, and first up is financials, and unfortunately we have more bad news in the stock market, with the financials closing down even lower today, forming another lower low and failing to hold up at this critical support level. So remember, I keep saying this, if the financials are going to a bear market, which it now looks like they are, I don't expect to see the SP 500 go and form new all-time highs. The financial sector is showing that there's issues right now, and we have to acknowledge the fact that if the financial sector is having issues, we're not going to see the rest of the stock market continue to scream to higher new all-time highs. So right here on the financials, we do have lower highs, and now we have lower lows, and we have that bearish trend with the price action closing below all the moving averages, and that 20 simple moving average rolling over and heading negative. So overall, very bad news in the financial sector. And if the financial sector is in a bear market, I'm not expecting the rest of the stock market to go back into a bull market anytime soon. Next up is the industrial sector, and we do see industrials having a little bit of a bounce today, going up 1%. But we're still holding up on that 50 EMA, and we still need to have time to see how this bearish trend is going to play out. Now, we are trading below the 5 EMA, and we have seen that 5 EMA cross back below the 13 EMA, which is telling us that the trend is now bearish. So right now, we need to see if we're going to come down and close this gap at $72, and then we will assess if we're going to see that bullish reversal. But right now, we just need to watch if the industrials can hold up on their 50 EMA and find support and try to reverse this bearish trend. Next up is healthcare, and we see a follow through with the sell-off in healthcare, and we still see this bearish trend picking up momentum, and we see that 5 EMA starting to slope negatively to the downside. So the healthcare sector could still be in an ABC correction, and remember, we're just waiting to see where the end of this correction is, and then we will see if the trend reverses before ultimately heading back higher. So healthcare is saying that there's still more downside coming, and today's price action was no surprise because we already saw the trend breaking down ever since that 5 EMA crossed back below that 13 EMA. We knew that we were going into that correction and that we were going to see this sell-off happening. So I still fully expect September to be that correction month, and I wouldn't expect this volatility and this selling to go away until the end of the month, and potentially in beginning of October. We'll see if those buyers start coming back into the stock market. But don't forget, we have the election coming up, and I wouldn't expect to see a lot of people getting bullish right before a big election because they don't know what's going to happen and they don't know who's going to get elected yet. Next up is the US dollar, and we're looking at DXY, and we still see the US dollar gaining strength, absolutely blowing out to new higher highs, which is telling us that we now have that bullish trend. We officially have a higher low, and with today's close, we have that higher high, and we are seeing the dollar show strength. And if the dollar is showing strength, we're going to expect the stock market to continue to correct, which tells us that today's bounce was most likely just a technical bounce, because typically speaking, when the dollar goes higher, we saw the stock market selling off. Just in the same way, when the dollar was going lower, we saw the stock market going higher. And now that the dollar is going higher, we're going to expect the stock market to continue to go lower. So remember, the dollar and the stock markets are completely inversely related right now. And that's because as the dollar weakens, we wanted to see those asset prices inflate to make up for the dollar being weak. But now that the dollar is strengthening, we want to see those asset prices correct because now the dollar is showing more signs of strength. So the dollar is going into a very strong bull market, it looks here. And you could see with today's close closing back above the 50 EMA. And we're starting to see that 5 EMA break back above the 13 EMA, which shows like the dollar is ready to go on a bull run. Now let's jump right over to gold, because if dollar is going into a bull market, we would not expect to see gold continue to go higher. And that's exactly what we saw today with gold closing back below support levels. So right now I would be a seller of gold because gold has significant more downside. And our next support level at gold is all the way down here about $1,800. So if gold has more downside to go and we're seeing the dollar strengthen, I wouldn't be a buyer of gold right now. And if you have gold, you could just hold it through this to see what happens. But moral of the story is, while the dollar is strengthening, we don't want to be a gold bull. So today's close on gold was not bullish at all. We broke down through very critical support levels, and that means our next support level is much lower down here at $1,800. So we'll look for another buying opportunity if and when we get down there. Next up, let's take a quick look at Apple, which is our market moving stock. And we see Apple actually went up 1.5% today, closing back above its 5 EMA as well as the 50 EMA. However, the price action could still find resistance at the 13 EMA, as we've seen before, where it gets up here and then gets rejected. We are only one day away from testing that 13 EMA and seeing if it's going to act as resistance. We have the 20 simple moving average heading negative, and we still have this gap below us at $96 that we could easily come down here and fill before we ultimately resume that bull market. So right now I'm still giving benefit of the doubt to coming down and filling this gap. And I think the stock market bears know that that gap is there, and they know they're coming to a critical resistance level that they can short into and drive the market lower. Now, I do think once Apple gets to 96, I think the bulls are going to step in and drive Apple back higher. But I would not be a buyer of Apple just yet, and I would be patient and remain cautious on the price action because we're still seeing bearish price action closes and bearish trends building. Next up is Tesla, and Tesla closed right on a critical influence level, right at the 20 simple moving average, which, as we know from the previous bounce, the 20 simple moving average has been holding up as support. So that 5 EMA crossed back above the 13. We had a price action close above the 20 simple moving average. And then we came down here and tested and bounced, and now we're coming back down and bouncing again potentially. If we do bounce again, I'm expecting Tesla to come back up and test the 500s. But if we do break down, look out below, because this still could be a full ABC correction. And we could see a lot more downside on Tesla because of all of the dumb money in this stock. Now, I'm not saying that to be mean. Dumb money is just the retail investors who FOMO'd into the stock and don't really know what they were buying. And they will be the first ones to panic and the first ones to run for the exit in any event that the price action starts breaking down and heading to new lows. So right now, if you're a Tesla bull, this could be a potential buying opportunity. But for me personally, this is a FOMO stock, and I'm staying far, far away from it. Next up is Bitcoin. We see Bitcoin coming back down and testing its support level, and we did see a bounce off support, but we are trading right under the 20 simple moving average right now. So to be a full bull on Bitcoin, we really want to see it close back above that 20 simple moving average and come out and take out this previous high around $11,000. If we can get back above 11,000, we should have no problem coming up and retesting 12,000. And if we could break above 12,000, I think we're heading to 14,000 in a flash. So right now, it looks like Bitcoin's still taking a second to cool down and see what the US dollar is going to do. and Bitcoin really is a good hedge to the dollar as well as gold. So as the dollar strengthens, it's not surprising to see Bitcoin take a second to cool off of its bull trend. So going back to the SPY ETF, we're still bearish because of the price action closing below the 5 EMA and the 50 EMA, and we still have that bearish trend with that 5 EMA going down below the 50 as well as staying below the 13 EMA. So as long as this trend is bearish, we're going to remain cautious, and I advise you to protect your capital and don't be in a hurry to jump into this market. There's always going to be more clarity the more price action we get and the more we let the trend develop, and the more clarity we have in the stock market, the better decision we can make with our capital and the more informed trades we can make to maximize our gains, because we'll know the risk and we'll know the reward before we enter that trade. So right now, if you are a buyer of stocks, I would have your stop loss below this $325 level on the SPY ETF. In any event we do break down below that level, we could go much lower to the 315s or the 305 levels. So protect your capital, control your risk with your position sizes and your stop losses. And as always, I hope you are doing successful trades and profitable trades, and I will always be here to help you out. So if you don't mind, please help me out by smashing that like button. And if you want to follow along with all of my technical analysis, please remember to subscribe to my channel. So thanks for watching, everybody. And as always, I will see you in the next episode.